Most people think investing is about finding the next big stock, timing the market, or getting rich quickly. But what if the real secret to wealth is simply not losing money? Over 70 years ago, a man studied how investors actually succeed, not by luck, not by hype, but by discipline. His name was Benjamin Graham, and his book, The Intelligent Investor, became the foundation of modern investing. Even today, it's recommended by Warren Buffett, one of the richest investors in history. This video will break down the book into simple, practical lessons you can apply starting today. Part 1. Investing versus speculating. Let's start with a brutal truth. Most people in the stock market are not investing. They're speculating. Speculating means buying because price is rising, buying because others are buying because of hype. Investing means buying based on value, holding long-term, thinking logically. Graham says, an investor is someone who analyzes carefully, protects capital, and seeks reasonable returns. If you're chasing quick profits, you're not investing, you're gambling, and markets punish gamblers. Part 2. Mr. Market Story. Graham explains the market using a simple character, Mr. Market. Imagine you own a business with him. Every day he offers you a price to buy or sell your share. But here's the problem. Mr. Market is emotional. Some days he's excited and offers very high prices. Other days he's depressed and offers very low prices. Most people follow his mood. Smart investors don't. They use him. When he offers cheap prices, buy. When he offers crazy prices, sell. Other days, ignore him. The market exists to serve you, not to guide you. Part 3. Margin of safety. This is the most important concept in the entire book, margin of safety. It means buy with a cushion. If a company is worth $100, don't buy at $100. Buy at $60 or $70. Why? Because mistakes happen. Markets crash. Companies struggle. But if you buy cheap enough, you're protected. Graham says, the secret of investing is not high returns, it's avoiding big losses. One big loss can destroy years of progress. Margin of safety prevents that. Part 4. 2 types of investors. Graham divides investors into 2 types. 1. Defensive investor. This is most people. You don't want to study markets daily. You want stability. Strategy? Index funds, diversification, long-term holding, monthly investing. Simple, safe, effective. 2. Enterprising investor. This person studies companies deeply, looks for undervalued stocks, spends time researching. More effort, more potential return. But Graham warns, don't choose this path unless you're truly committed. Half-knowledge investors lose the most money. Part 5. Market crashes. Markets go up, markets go down. This is normal, but most people panic. They sell when prices fall. They buy when prices rise. Exactly the opposite of what they should do. Graham says, the investor's worst enemy is likely himself. Emotions destroy returns. The intelligent investor stays calm in crashes, buys when others panic, thinks long-term. Crashes are not danger, they are opportunity. Part 6. The Real Secret. This book is not about stocks, it's about behavior. You don't need perfect timing, secret tips, complex strategies. You need discipline, patience, consistency, emotional control. Wealth is built slowly, not in weeks, not in months, but in years. If you invest regularly, avoid big mistakes, and stay consistent, your financial life will look completely different in 5 to 10 years. Final message.
You don't need to be a genius to become wealthy. You need to be calm when others panic, patient when others rush, logical when others are emotional. That's what the intelligent investor teaches, not how to get rich fast, but how to build wealth safely and keep it for life. Start simple, invest regularly, think long-term, and most importantly, control yourself. Because in investing, the biggest risk is not the market,